How are you?
Yeah, I'm good, thank you. Thanks for joining us. Little tight on time, but so let's crack straight into it. Do you just want to give a brief overview of your company and what you do and your strategy, and then we'll go into questions?
Yeah, absolutely. Our absolute focus is on urban logistics buildings, which sits really between, in terms of the whole industrial and logistics stratosphere. You have Tritax big box dominating the big box arena on one end of the spectrum, and at the other you've got the MLI, multi-let industrial space. And broadly speaking, big box represents buildings of 300,000 square feet and above. MLI tends to be 2 to 25, 30,000 square feet, and we occupy the bit in the middle, which is we sort of think of it as 25,000 to 250, 300,000 square feet. So our buildings provide the last mile or last touch distribution home for supply chain, and that is principally what we invest in. We look at the whole investment business case through the lens of a management team who've been around for in excess of 30 years, and we've known for many years that long let buildings will go up and down with the tide, depending on, as we've seen in the last 12 months, what base rates are doing and so on. However, we always set out to be a value add opportunistic player, where we wanted to buy buildings that we could actually do something to, whether that be improve their ESG characteristics, whether it be increasing rental income, whether it be invoking more institutional lease terms, or whatever it happens to be. So we're a very hands-on asset management business.
Cool. Okay, and so we've got some slides here on your performance over the years, which are very good. Like I said, asset management plays a strong part of that. I don't know what should we crack straight into questions, or do you want to sort of talk to these slides a bit more?
Well, I think just judge looking at the performance side of life, we've delivered over 16% TPR every year since IPO in 2016. In the last year, which clearly has been a very difficult one, MSCI record 20.5% declines in the industrial sector, and we've reported a decline of only 5%, which is indicative of what I was saying earlier about the ability to offset the sort of decline in bond proxy type income by doing that asset management. And I think in the last 12 months we've demonstrated that, as we have in the previous 6-7 years of our business life.
Cool. Okay. Some questions sort of coming through already. I'm just conscious of time. Just over 15 minutes, so maybe we can just
far away.
Yeah, cool. Okay, so what we've got here, a couple on sort of demand and supply. So on the supply side, during the pandemic, supply chains moved from sort of just in time to just in case, which would significantly increase demand. Has this played out as you expected, or do you still think there's more to come, and if this is a permanent shift?
I definitely think there's more to come. I think the really important thing here is that people band around numbers like UK supply now still being at around 4%, which is up from 2.5% a year 18 months ago. Clearly, setting that in context, that's, in my 35 plus years of doing this, it is still, bar the previous couple of years, the lowest supply we've seen in the UK across the board. I think the urban logistics side of life was, if you like, the latter part of supply chain sophistication that occupiers needed to provide to deliver into your home or your business. And big box has been around for a long time, and those big regional, national distribution hubs have been operating on a hub and spoke type arrangement for years and years and years. What occupiers didn't have were the smaller buildings to store product, which then is on its last leg of the journey to, as I say, to your home or your business. So we believe there's still a huge amount of supply chain sophistication to happen, and we've let up our own development portfolio in record time, and we're still talking to occupiers daily around the facilities that they require. But the important thing to stress is that our focus is on essential goods. We eschewed fashion retail right from the outset, and of course, in a more difficult economic time like we're seeing now, guess where the highest customer failure is, and it's in fashion retail. It's in anything that could be construed as fashion, and our tenants are moving food, pharmaceuticals, as I say, essential goods around the country, every single day, and they need to get better at it. So we do believe there's a long way to go, and the supply side has been in many ways protected by the build cost inflation, which has seen not just the cost of actually erecting buildings, but actually the development sites themselves escalate. So the supply side is not coming through as one might imagine.
Yeah, there's a question here on supply. Is there anything to you to suggest that vacancy will shoot up excessively?
I think the reality is the well-capitalized top 6 or 7 developers in the UK will always focus on those large strategic sites where big box tends to happen. So I think you will see more speculative development, and therefore the supply demand imbalance in that space. You'll see that much more acutely in big box than you will in our sphere, because buying sites and constructing buildings close to urban centres is very difficult, not least because planning is very difficult and takes a long time. And so we're still very confident about the supply demand imbalance being in our favour.
Cool. There's a question here on Amazon actually, which I know features in your portfolio. So they've suffered from an overestimating of logistics demand. I think that's more in the US, isn't it, and Europe than in the UK. But
well, I think it probably applies to the UK as well, Richard. I think the reality is, I think when we were all locked down in COVID, and the only way to procure goods was over the internet, I think everybody felt like this was a structural shift that was never going to take a backward step. And the reality of life is, of course, that it was inevitably going to fall back once we could all get out and about and procure things. On certain products, one would typically want to procure directly from a store or whatever. These essential goods that I'm talking about, I think, are much easier to procure online. I think what I would say about Amazon is that their buildings tend to be very, very bespoke. That by far and away, probably 85+% of the warehousing that Amazon have in the UK will be in the big box space. The smaller ones, equally, they tend to have a very bespoke fit out, a very bespoke construction, which means that if they actually come out of these buildings, I think it is very difficult for other tenants to occupy. Okay. So I'm not worried about that. I think, to quote an example, a few years ago we had Travis Perkins came out of a building of ours in Bedford, and we relet it to a rice importer without anything in the building changing at all, except that the rent increased from, I think at the time, just under £4 per square foot to £6.25 per square foot. So, our buildings are much, much more generic. We look very, very carefully at our buildings before we acquire them or construct them to make sure that they're going to have broad appeal. So I do believe we're in a very different place.
Okay, cool. Looking where we should go next. So we've got a question here on Tufnells, which was one of your tenants who went bust a few months ago.
Yeah.
So what's the update on that? You relet most of those properties fairly quickly.
Well, what I should preface the answer by saying is that we always focus on very, very strong covenants, and we always focus very hard on the specifics of the building that we're looking at. The first thing we do when we go to sites to look at a new asset is we ask ourselves, how mission critical is the building to the operation? We want to understand whether that building would relet in the event of a tenant default or whatever. The one exception we have made on our 7-year journey has been with Tufnells, where those buildings are parcel delivery hubs. Tufnells were engaged in the last mile distribution of heavy and outsized goods, which most of the large parcel operators choose not to do, often because their highly automated buildings won't. If you take something like heavy engineering parts or home gyms or anything like that, they just don't fit the conventional highly automated model. So we always felt that them as a business would have a place in the market. We were perfectly cognizant of their financial constraints. But nevertheless, what we looked at was the real estate, and to build a parcel delivery hub. If you talk about a conventional building, when we IPO'd in 2016, 100,000 square foot conventional building was being built for between £23 and £25 per square foot. That is now nearer £90 per square foot, edging to 100 in more stubborn geographies. And then if you look at a parcel delivery hub, you're talking about at least double that. So we knew the real estate that Tufnells operated had a much higher value than a conventional building. We also, because we were acquiring sale and leasebacks from them, they wanted to have those buildings on low rent. And that suited us, because obviously that then meant there was going to be hopefully an opportunity for greater rental growth down the line. So for all of those reasons, we bought those assets. As we sit here today, of the 12 assets we have, DX have clearly acquired the Tufnells business. They have taken 8 out of the 12 buildings, and the remainder are in the throes of being assigned to another party, oblique parties, and we will be very happy with the outcome of them. And again, it just plays back to, I think, an experienced management team that know what they're doing, and we weren't, when the world was different, we weren't doing what many others were doing, which was just buying the sector. We were very, we said for a long time, you won't know how good we are until we have a downturn. And then I don't think I uttered those words for more than a couple of weeks when COVID hit. But then equally the same applies, as you go into a more difficult market, that experience, and that, our management team, we manage everything in-house. We have all of those tenant discussions in-house. We visit our tenants 4 times a year. We're in very regular dialogue with them. So, Tufnells being a good example, we were talking to them, if not fortnightly, then, certainly twice a month, typically. We would be talking to them about how they were getting on, and so on and so forth. And actually, it will prove to be a good outcome for us.
Yeah. Okay, cool. Question: you sold a couple of assets recently, I believe. So, what can you talk through sort of the rationale for that, and if there's any more planned?
Yeah, look, we've got a high degree of focus on our ESG credentials. We were upgraded to an A rating by MSCI. We take all of that very seriously, and I think in the 12 months prior to our last reporting period, our EPC ratings of A and B shot up from 22% to 52%. And as part of that, we wanted to identify those buildings that either the capital investment was going to be so significant to hit the 2030 target that we would sell and buy assets that were more modern and more able to satisfy all of that. So yeah, we sold a couple of assets which we're perfectly happy to do ahead of valuation, and we're looking at further disposals as we speak, albeit that the very, very vast majority of our portfolio is in the right territory in terms of being passing muster to hit the government deadline of 2030.
Yeah. Cool. Question here on sort of LTV and debt and stuff. Could you talk about your debt and how that's looking? I think you did a debt deal recently, and how that's looking, and how sort of what it costs and things like that.
Yeah, I think prior to the most recent activity, I think our total cost of debt was running at about 3.4% on 86% of our debt. I mean, what I should say is, and it plays back to the experienced management team point, you would expect us to keep LTV low in a time like COVID. We've always said we'll operate between 30 and 40%. COVID hit. I think at the time our LTV was around about 23%. We collected all of our March 21 rents. We then collected all of our June rents, and that gave us the confidence to continue to deploy. But we've deliberately kept our LTV at the lower end of that 30 to 40 range, and continue to do so as things are where they are now. So we were quite surprised by some of our peer group and their sort of relaxed approach to debt structuring. We're here to manage real estate, and ultimately, taking debt risk is not something that we felt was within our remit. As we sit here today, we've paid down a revolving debt facility. We've taken out a further loan with Aviva. I think our total cost of debt now across the board, the debt is to term of 2027 and 2028. And I think the total cost of debt now is 4.4% today. So we're pretty happy with where we're at. With our low LTV, with some asset recycling, we could very easily pay back some of that slightly more expensive debt and return into a sort of mid 3% scenario quite easily, and we think that puts us in a pretty strong position.
Would that be preferable to say buying back your own stock? There's a question here on that.
Yeah, look, we, like many of the sort of issues that we could talk about, our board review all of these things very, very regularly. Share buybacks were discussed at the last board meeting. We, for a multitude of reasons, decided not to pursue that. We looked at comparable share buyback activity, across the market over the periods over recent history, and the conclusion was we would rather stay where we are in terms of share buybacks and continue to focus on buying real estate that we believe could deliver the returns that we've always offered.
Yeah, no, that makes sense to me.